The United States has a unique financial system unlike any other in the world. It's a complex web of policies, regulations, and mechanisms designed to keep the economy stable and growing. One of the most critical components of this system is the debt ceiling. The debt ceiling is essentially a cap set by Congress on how much money the federal government is allowed to borrow to meet its existing legal obligations. Right now, the U.S. is dangerously close to hitting this ceiling, which has significant implications for the economy. If the ceiling is reached, the government might not be able to pay its bills, leading to a potential default on its obligations. To prevent this scenario, the Treasury Department employs a strategy involving the Treasury General Account, or TGA. The TGA acts like the government's savings account, a reserve of funds that can be tapped into when necessary. When the debt ceiling is reached, the Treasury can withdraw money from the TGA to continue funding government operations. This process is known as a TGA drawdown, a crucial maneuver to maintain financial stability. The drawdown allows the government to keep paying its bills, ensuring that essential services continue uninterrupted. By injecting more dollars into the economy, the TGA drawdown helps to sustain economic activity and consumer confidence, even in times of financial uncertainty. The TGA drawdown injects liquidity into the financial system. This process is akin to releasing a reservoir of dollars into the economy, making more funds available for various financial activities. Think of it like adding water to a pool. Just as water levels rise, increasing the pool's capacity, liquidity levels in the financial system rise, enhancing the overall economic capacity. More water means the pool is fuller. Similarly, more liquidity means the financial system is more robust and capable of supporting economic activities. More liquidity means more money is available for people to invest and spend. This increased availability of funds can stimulate economic growth and consumer spending. This can influence asset prices, including those of stocks, bonds, and even cryptocurrencies like Bitcoin. When investors have more money, they are more likely to invest in various assets. When there is more liquidity, asset prices tend to rise. This is because the increased money supply boosts demand for these assets. This is because there is more demand for them. Higher demand, driven by increased liquidity, often leads to higher prices. Investors have more money to put to work and are more likely to buy assets. This increased buying activity can drive up the prices of these assets. This increased demand can push prices higher. As more investors enter the market, the competition for assets intensifies, further driving up prices. This is a basic principle of supply and demand in action. When supply remains constant but demand increases, prices naturally rise. This dynamic is fundamental to understanding market behavior. Bitcoin, often called digital gold, has shown a correlation with liquidity in the past. When central banks around the world injected trillions of dollars into the economy during the COVID-19 pandemic, Bitcoin's price surged. This was partly due to the increased liquidity finding its way into various asset classes, including Bitcoin. This correlation, however, is not always straightforward. Bitcoin operates in a complex ecosystem influenced by various factors. While liquidity plays a role, it's essential to consider other elements like regulatory news, technological advancements, and overall market sentiment. Section 4. Bitcoin, a safe haven, amidst uncertainty. The potential for the TGA drawdown to boost asset prices could shift investor sentiment. As the Treasury General Account releases funds, it injects liquidity into the market, which can have a significant impact on various asset classes. This influx of capital can lead to increased buying activity, driving up prices, and creating a more favorable investment environment. If investors see asset prices rising, they may become more optimistic about the economy. This optimism can lead to a positive feedback loop, where rising prices encourage more investment, further boosting asset values. The overall market sentiment can shift from caution to confidence, making investors more willing to take on risk. This could lead to a risk-on environment, where investors are more willing to invest in assets considered riskier, like Bitcoin. In such an environment, Bitcoin often benefits as it is seen as a high-reward investment. The increased demand for Bitcoin can drive its price higher, attracting even more investors. Some investors view Bitcoin as a hedge against inflation and economic uncertainty. With traditional currencies potentially losing value, Bitcoin's fixed supply makes it an attractive alternative. Its decentralized nature means it is not subject to the same risks as fiat currencies, which can be influenced by government policies and economic conditions. They believe that Bitcoin's decentralized nature and limited supply make it a valuable asset in times of economic turmoil. Unlike traditional assets, Bitcoin is not controlled by any single entity, which adds to its appeal as a safe haven. Its scarcity, with only 21 million Bitcoins ever to be mined, further enhances its value proposition. If the TGA drawdown creates economic uncertainty, investors may turn to Bitcoin as a safe haven. In times of financial instability, the appeal of a decentralized, scarce asset like Bitcoin becomes more pronounced. Investors looking for stability and protection against market volatility may increasingly consider Bitcoin as a reliable store of value. Section 5. Timing is everything. Navigating the financial storm. The timing of the TGA drawdown is crucial. It coincides with other major financial events, such as ongoing debt ceiling negotiations and potential interest rate hikes by the Federal Reserve. These events could amplify the impact of the TGA drawdown on financial markets, creating volatility and uncertainty. Bitcoin, known for its price swings, could react sharply to these developments. Understanding the interplay of these events is essential for navigating potential market turbulence and identifying opportunities within the Bitcoin market. Section 6. Charting the course indicators to watch. To predict Bitcoin trends in this environment, it's crucial to monitor several key indicators. Closely follow news regarding the debt ceiling negotiations. Any signs of progress or, conversely, a stalemate could significantly impact market sentiment. Keep a close eye on liquidity changes in the financial system, including the pace of the TGA drawdown. Additionally, monitor traditional market indicators like stock market performance, the US dollar index, and gold prices. These can offer insights into overall risk appetite and investor behavior, potentially providing clues about Bitcoin's direction. Section 7. Bitcoin's potential trajectory. Riding the wave of fiscal uncertainty. The anticipated effects of the TGA drawdown on Bitcoin are multifaceted. Increased liquidity could propel Bitcoin's price upward as investors seek alternative assets. Conversely, the uncertainty surrounding the debt ceiling and potential market volatility might trigger risk aversion, leading to a Bitcoin sell-off. The situation remains fluid, demanding vigilance and adaptability from investors. By closely monitoring the evolving dynamics of the debt ceiling, the TGA drawdown, and their interplay with broader market forces, Bitcoin investors can position themselves to navigate the potential opportunities and risks presented by this unique economic landscape.